Today, we're looking at how the high cost of borrowing is impacting how Americans feel about the economy. Bloomberg's David Westin sat down with Judd Cramer, a Harvard lecturer who penned an article with Larry Summers about the trend. David asked him why consumers aren't buying the story of a strong economy despite some of the data.
Traditionally, economists have been able to look at GDP growth, inflation, and unemployment, and from that really get a good measure of where consumers will have been. But this time around, something seems to have broken. And so that's what led us to really try to dig into the inflation measures and see what might have been different now versus how we were measuring things in the 1970s.
So how is it different now than the way we were measuring it in the 1970s?
Yeah, so before 1983, housing prices and, crucially for our research, mortgage rates were included in the CPI. So when we saw mortgage rates jump last year from 3% to 7%, if we had been measuring inflation the way we did in the 1970s, instead of seeing inflation peak around 10% last year, we would have seen it jump all the way to 18%. So when we take that that old methodology and apply it to current data, it kind of makes more sense to us why consumers are still in the dumps. Not only did prices rise, but after that, interest rates rose so much. And that's something that has really been weighing on their finances.
For those of us old enough to remember, there was something called the misery index that I guess came actually from Arthur Oken. I'm not sure I knew that before I read your paper. But why did we move away from that misery index? Why did we take out some of those borrowing costs that affect consumers?
Yeah, what's interesting is Arthur Oken and the misery index was so pivotal in explaining the way people were feeling about Jimmy Carter that we've sort of kept using it going forward, and folks are still looking at CPI inflation and the unemployment rate, but what they don't necessarily realize is that the way we've measured inflation has really changed. So what we did is we reconstructed the original misery index from Arthur Oken, and what we show in the paper is actually that's much more powerful than the simplified Oken misery index that we look at today. And if we use the old measure, we can actually explain about 70% of the so-called vibe session that we are currently experiencing in the United States.
And from your paper, I take it that you basically use as a consumer sentiment indicator the University of Michigan, my old alma mater, University of Michigan Consumer Sentiment Index. Does that track with your new inflation index?
We think that the Michigan sentiment is the best measure, and that is what people have been citing because it's really been lagging other economic indicators. But as we say, when we sort of broaden the scope a little bit on some of those indicators, it does a much better job of explaining what's going on in the University of Michigan index. We haven't explained all of it. There's certainly some room for partisanship or inequality or some other American-specific factors, but we do think that thinking about borrowing costs and the cost of money that everyday Americans are paying goes a long way to explaining why they feel the way they do about this economy.
So a big issue in financial markets right now is what is the Fed going to do with interest rates? When are they going to cut? How much are they going to cut? Or even some people even suggest they might conceivably raise. Take your analysis. Let's assume the Fed decided today we're going to use your measurement of inflation. How might it affect monetary policy?
Certainly, there would have been no impetus for the idea of rate cuts starting at the end of last year. By our old measure, inflation would still be 8% in November of last year. So certainly they would not have been thinking about using the rate policy to try to stimulate the economy.
So the inflation rate would be higher under your measurement than what we're seeing right now. On the other hand, part of the inflation on your measurement would include the cost of borrowing with the Fed, which the Fed affects. I mean, if its job is price stability and one of the prices is actually the price of borrowing money, they could actually bring down, if you will, your inflation measurement by cutting rates, could they not?
Yeah, so partially. And that's one thing that we looked at when we went back to the Volcker era. We actually think that by Volcker raising rates a lot at the beginning, he made the inflation that he eventually slayed look a lot harder than it actually was. And that's why the two things were more comparable. But yeah, you could get into this circular issue where the cost of money is part of the cost of living. So if we raise interest rates, we're raising the cost of living, but actually that's the antithesis of what we're trying to do. So that's one of the other reasons why I think sort of punting on the issue of the cost of money and excluding it from the CPI is where we landed. But yes, it's a very interesting argument because when you ask people on the street, they certainly consider the cost of borrowing, the cost of their credit card debt, the cost of car financing, or the cost of mortgage, part of their consumption basket. But putting that in the measure that the Fed targeted could get us in odd directions.